What's up everyone and welcome to the video. So we're going to be talking about why SMC 1 minute time frame is absolutely killing your trading and how to actually solve that problem. So without further ado, let's get straight into today's video. Right, so instead of you being sucked into this big pendulum swing of smart money traders targeting these bigger RR trades with tiny stop losses and it's going to lead to a multitude of problems if you're not careful, let me provide to you a solution, and I'm going to talk you basically all the way through it, give you some homework to do, and this is going to improve your trading dramatically. So let's get into it. Now, the big problem, which I'm going to show you an example of on the markets really soon on a trade on pound yen, right? The big problem is a lot of people get sucked into the marketing tactics of a lot of places, and it's just that greed mentality of wanting to get the tighter stop loss and target the bigger risk reward trades. But the thing is, you have to ask yourself, is that very realistic and logical from a scalability model, right? You may be all right doing that on a smaller account, but as you scale, you're going to run into a multitude of problems that you may not even be aware of yet. So it's important that we actually touch base with this and actually figure out the problem and how to actually solve that as well. So let me talk you through this trade. So let's play this trade out on pound yen. So I've got an order set and it's a sell limit. So just to talk you through quickly, what I'm seeing within the trade itself, and then we'll get into the main point, is this is currently aligned to my style. So what we've got, we've got liquidation of the previous high, right? Price has come down. So this on a daily time frame is that sweep of previous liquidity. Clear movement to the downside here. We've then stalled in price prior to then breaking structure, causing the shift in market structure, right? Price is then correctively pushed back up, swept this liquidity to the left, and this is looking really nice from an intraday perspective as well. 15-minute time frame, we've then swept Asia high, swept liquidity to the left. We're in a clear area of value. I'm looking for short plays. So from a lower time frame perspective, once again, entry model is actually shaped up. Let's play this out a little bit. All right, so I would have been tagged into the trade here. So providing this is a 250k demo account, just to kind of show you, the gist of the point, and this is a backtesting session for me as well. A lot of you will have goals of trading a high 6 or even 7-figure account, right? But you have to think, right? 1% of a 7-figure account is 10 grand, right? 10% of that is 100k, right? So if you're running at these bigger RR trades, let's say it's even 7, 8, 9, 10% in profit, you're telling me that you're not going to want to pay yourself, that maybe you're happy to remove risk but you're happy just to let these trades just be open, let these bigger RR trades pull back. Let's say you're running at 10% or even 20, 30. We're talking big figures on a 7-figure account. That's 100, 200k, 300k running in profit, floating profit and loss. You're telling me you're not going to be wanting to have a partial out, take profits, pay yourself in full. None of that because you're holding out for these bigger trades just because your ego tells you to. You're not going to be doing that at scale. Honestly, it's a recipe for disaster. You're much happier. This is why you have to think in scale as well. Not to bash at anyone within the space or anything, I'm sure people do this, but for myself, I can't imagine anyone does this at scale, or there's very few people that do this at scale, because you're going to run into a multitude of problems, right, that people don't even talk about. Trading smaller stops, let's say you have a 1 pip stop or a 1.5, 2 pip stop, 3 pip stop, right, there's so many problems that you're going to run into, such as, number one, not even being filled on positions, because I've talked to a fair few people who are trading a lot larger capital than a lot of people in space. They struggle sometimes to get filled on 10 pip stops. So to think you're going to be getting filled on 2, 3 pip stops is insanity, if you ask me. Then you got into the problem of slippage, right? If you're using a 2 pip stop and you're in a trade and news comes out or something unexpected happens in the markets, you're much more likely to lose a bigger amount on that trade with a smaller stop. So you could, instead of losing 1%, let's say you risk 1% per trade on an account, it will be so easy for you to lose 2, 3%, 4%, 5% on a single trade, right? It's happened to me trading 5, 10, 15 pip stops, right? The amount of times in the past where I've been slipped on a trade, and instead of being taken out for 1%, I've been taken out for 1.5, 1.8, 2%. It's happened so many times that I've actually been burnt, and I've learned from this. So this is live market experience coming to you. And I'm telling you, if you're using 2 pip stops on scale, you're not going to be doing it at scale. You are not going to be doing it at scale. right? And you're happy to pay yourself. Why would you risk holding out for these bigger RR trades when you can just pay yourself, have a stress-free mentality when it comes to trading, and start paying yourself when it comes to 3-to-1s, 4-to-1s, let's say session lows, session highs, an intermediate target, maybe even trailing your stop, is going to be a much more effective approach than holding out for these bigger trades, right? And it's a trap that a lot of smart money traders get into, and it's going to take you a long time to get out if you're not careful. So instead of actually having a failed recipe, let me talk you through how to actually solve that, right? So let's talk through this trade. So I've been triggering into this trade now. Let's play it out a little bit. All right, so this is the M5 time frame, and at a 3-to-1 basis, I would have been taken out, right? So the profit, so I've gone from a 250k account to then 258,702, right? So I'm paying myself. But let's say you would have held out, right? And let's say this is just a clear example. There's many more examples I can come across. And let's say you hold out because you believe price is going to take Asia lows. It's then going to go on to take out the swing low. But price, you don't know what the market's going to do next. The truth is that, right? And the market has other plans and then actually pushes higher. Right, so price comes down, fails to take out this low. Then we start taking out the high to the left, and then we go on to create higher prices, right? So yes, you would have taken a break even and you would say on to the next trade, etc. But you're not paying yourself. Yes, you might get that trade that banks you a good percentage, but you got to think about the stress that comes with that, right? If your strike rate's lower, trading at scale, and you're holding out for one trade to bank you a large percentage, that's going to be so stressful, and you're more so getting into the mentality of gambling. So if you're getting to the mentality of gambling, you may as well go to Las Vegas and go and spend the money in a different way in a casino. Honestly, you're much better doing that than doing this sort of style, because it's not going to benefit you and it's going to cause you so much stress. Whereas imagine the stress-free approach of targeting 3-to-1s or session low, session highs, or an intermediate target that you're consistently paying yourself because you have a system in place to do so, right? So much easier on the mental capital and the physical capital to scale that way consistently. I'm not looking for an equity curve that goes boom, 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 like flipping boom and bust cycle.
Nice.
I want it to be smooth, I want it to be consistent, and I want it to be like that over time. Right, so I'm going to set you a little bit of homework to do just to really prove this to yourself, because this can really impact your trading. So what I want you to do is go onto Eurodollar or pick a pair of your choice that you trade, go to 2022 data and backtest the first 6 months of the year. And I want you to actually set a management approach of a 3-to-1 risk to reward strategy, right? So no alterations to your execution, your entry model, but instead of managing the way you manage, set a TP at 3-to-1, and I want you to track that on a spreadsheet and see how it forms over the course of 6 months. The reason being is because, once again, you can go and you can adjust this later down the line. You may come to a solution that you're better doing 2-to-1s, 4-to-1s, 5-to-1s. You may even be better targeting swing low, swing highs, trailing your stop, session low, session highs. There's multiple ways to manage trades. However, this is a very good starting point, because instead of doing what a lot of smart money traders do, and they go, I'm targeting these bigger RR trades, trying to hold out for these bigger risk rewards, they're going into the deep end backwards. Why not actually start off targeting 2-to-1s, 3-to-1s, prove to yourself you can do it consistently, and then if your system and your data tells you you can maybe hold out for more RR, or you may be better trailing your stop, etc., then actually do that. But you better start from scratch and work your way forward easily. Don't run before you can walk. It's better to do this consistently over the long term. But the problem is people want to flip accounts, and this is the mentality creeping into people's trading. But if you do this, this will set yourself up for success in the long term. So backtest the 6 months of data and notice how it impacts your P&L, your win rate, your strike rate. Just naturally pay attention and use your instinct here and your logic to see, right, would this be a less stressful approach if I actually applied this in the markets? And how would that affect my equity curve? How would that affect my mental well-being? How would that affect my just consistent edge over time? Would I be better trading this way? So really think about that, and then what I want you to do is actually let me know. Let me know on private message. Let me know on the comments on my next YouTube video. Just let me know, because that's going to be really helpful for you to actually apply that, see the data for yourself, and if it's better for you, then actually adjust and trade that way more consistently. for scalability. So that's going to be really good. Let me know how you get on. And it's such a small tweak that most people don't think about that can completely change your trading from being maybe a losing trader, break-even trader, to doing consistent months consistently if you have your mental game in check and you have this technical game in check as well. So it could really actually impact you. So keep me updated. I want to see how you get along, and hopefully this video has been helpful. Hopefully it's been insightful, and take this from someone who's been in the markets for 6 years now, been through multiple systems, and I've seen just so many pendulum swings in the market, and it's just made me super aware of doing things for the longer term instead of that short-term gratification that most people seek. So pay attention, apply it to yourself, and I'm looking forward to seeing the results for yourself. But until next time, see them.